Individual investors are prone to a range of behavioural biases that can have a detrimental impact on their investment returns. So what, if anything, can they do about them? Here's James Norton from Vanguard Asset Management.
So I think the first point to note is that you're unlikely to ever overcome all your biases. They're so heavily ingrained in us. However, just having a realization that you've got those biases is a great starting point.
So ridding yourself of your biases is probably unrealistic. There are ways, though, of reducing the negative impact they have.
The first one is to keep taking yourself back to your goals. Why have I invested? What is the long-term goal? If you understand what the long-term goal is, then that can really help put the short-term into focus. The second thing I would do is, when you make big investing decisions, just take some simple notes. What have you done and why have you done it? And then when it comes to making a change to your portfolio, say you want to change the bond equity split because of euphoria or market depression, or you want to buy a different fund for whatever reason, just go back to the reasons you set up your portfolio and why you made those decisions. The chances are they were very sensible at the time. And if you revisit those, it will just help you think, is this change really necessary? 9 out of 10 times it probably isn't.
Another way to minimise the damage caused by your behavioural biases is to have a clear process and to stick to it.
And one of the best ways to do that is just the discipline of having a rebalancing process in place. And that is on a periodic basis. It can be once a year, it can be depending on market movements. Different people believe in doing it differently. Just taking profits out of holdings that have done very well and topping up holdings that have done less well to keep that risk level at an appropriate level for you.
But probably the most effective way of dealing with your biases is to have someone join you on your investment journey, an objective third party.
You may have a friend, or it could be an advisor. You know, maybe someone you actually genuinely value paying to keep you on track and to help you make those difficult decisions. And they do tend to be difficult decisions because the time when advisors really add the value is when you're feeling uncomfortable or particularly joyful. You're feeling uncomfortable because you're having a review meeting and your portfolio's down. And you won't be happy, the advisor won't be particularly happy either. But actually keeping you on track then is a huge value add to rebalance the portfolio, go through the checklist of sensible things. Likewise, if the portfolio is doing very well, just to temper in the euphoria, actually take some of the profits, redeploy it in the fixed income, and keep you on track.
Again, you can't expect to eliminate your biases, but the good news is that you can do something about them.